Let's learn future value in this video. What do you mean by a future value? Future value is nothing but the amount of money you receive in the future for the investment that you made today. Let's say you have invested 1,000 rupees today. Today is March 2026, right? Let's say I invested this in a bank, and the bank gives me 6% interest rate annually, right? So what do you think by the next year my money would be? If I keep on investing, if I hold that investment for 1 year, that is 12 months, what do you think my money would be? Equal to this into 1.06, that is 6% interest. The investment into increase in the investment for 6%. Enter. The 1,000 rupees would become 1,060, right? This increase of interest with the principal is called your future value. This is a present value and this is a future value. Why this is a present value? Because today we have this amount of money now. The same money you haven't invested anything except this 1,000, and the money is not same after 1 year because you have gained some interest from the bank. This is the concept of future value. Let's say I want to keep on investing, I want to stay invested for next 5 years, that is March 31st. Okay, so what do you think my investment would be? Let's see. The investment by the end of 5th year is 1338 1338, right? So this is one method of calculating future value. Then I will show you the second method. There is a formula for calculating future value. Most of the accounting and finance students would already know this. Basically, the formula is future value equal to present value into 1 plus r whole power number of years. Right? Here, r is rate of return and n is number of years. Let's apply the formula here. Equal to present value is 1,000 into 1 plus rate of return is 6% with the bank, and whole power n is just 5. We have arrived at the same number. I'll show you an interesting thing. The third method, we have a function called future value. In this future value, the rate is 6, NPR is 5. PMT, we will talk about the PMT later. Let's put 0 for now. And the present value should be in negative always, because present value is money going out, right? Present value is money going out and the future value is money coming in because you're making an investment. So the final amount, again the same amount. So these are three methods to calculate future value of a cash flow or a investment. Let's do few examples so that it makes your concept clear. Here we have annual interest rate and number of years investment. This is monthly investment, this is present value, and this we will talk about it later, right? Let's say I have 5 lakhs in my bank account at the moment. Right now I have 5 lakhs in my bank account and I want to make some money. So I'll go to a bank and I will invest for 3 years, and with an for an interest of 8%. Let's say I have gone to two banks. One bank is offering me 6% interest rate and the second one is offering me 8% interest rate. So I'll take the 8% one and I'll apply the formula. Future value is the rate, comma, look at this column here, look at this box here, the formula box, this is popping up. Rate is this, NPR is highlighted, so we have to do this, select this, and payment is this, just for now 0, and the future present value would be in negative. It's already in negative, so this is your future value. It's as simple as that. But 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 what if you want to calculate as if you are investing in the beginning of the year, as if the interest rate calculated in the beginning of the year, right? Equal to future value, rate is this, NPR is this 3 years, comma, payment is nothing for now 0, comma, and the present value is in negative. This is absolutely perfect, comma, and the type, look at, listen to me very carefully, the type is end of the period or beginning of the period. End of the period is simply payment is timed at the end of the period. That means the investment is made at the end of the period, not the beginning of the period, right? If I am making 5,000 every month, if I'm investing 5,000 every month, the payment is making at the end of the period. So I will have empty month. If I make the payment at the beginning of the year, by the end of the month I would have made some interest, right? Remember this always, beginning of the period investment would make more interest, right? If you invest end of the month, you have already lost 1 month of interest. All right, so that's how it works. Let's say we are investing in the beginning of the month, beginning of the year, so it would be this much. We'll keep on addressing this so that you get clarity on the concept. So this is interesting. Now let's see the future value here. The rate is similar, 8%, and the NPR is this, but we have monthly investment here, investment monthly amount, right? Every month I am going to invest 5,000. So here there is a problem. If the monthly investment is in months and the time period is in years, then the formula doesn't work. All right, if there is something in monthly, everything should be in monthly. If there is something in yearly, everything should be in yearly, right? So what do we do is we convert every single thing into months. This is 8% annually, so we convert it into months by dividing by 12. NPR is 5, but we multiply it with 12 months, so that it gives us a number of months for the investment, comma, PMT is monthly investment, and it is in negative because money is going out, and here present value is in negative, money going out, it's true, and type is given. That's it. This is your investment, future value of the investment. So you can do the same thing here, copy this and paste it here, but but this is 5,000 monthly and we don't have a present value. Is that a problem? No, it's not a problem, because sometimes I don't invest lump sum amount in the mutual funds in the beginning. I want just 5,000 per month investment, and it is possible, right? It is possible, right? So basically these two things are similar, except one thing, there is a present value here, there is no present value, right? That's the only difference. Then let's do this one, right? Even for this, copy here and paste it here. Here you have done monthly, but it is not necessary. All right, you could have done just yearly because there is no monthly investment, so you don't have to convert this into monthly data. This rate is 13, NPR is 5.5, PMT is 0, and present value is in negative, right? And the type, that's it. Here what we have to do is, again we have a monthly interest, monthly payments, so we have to calculate based on months. Okay, So future value rate is this divided by 12, comma NPR is this into 12, comma PMT is negative, right? Future present value is negative, and this is in 1. So the investment is right, equal to future value. For this, the rate is this, but divided by 12 due to conversion into month. This into 12, PMT is this, and present value is this. Done. This is how it works. So you can copy this and paste it here. Listen to me very carefully. If I change this into 1, the investment would increase. The future value would increase. It is 12 lakh 85,000 right now. If I put 0 here, that means if I invest by the end of the period, it is 12 lakh 85,000. If I put 1 here, it is 12 lakh 89,000. The increase of 4,000 rupees in interest, right? This is the difference. So if you like this kind of content, please subscribe. Thank you.